I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And today I just want to talk a little bit about the Fed. In my opinion, I'm a little fed up with the Fed because I think they were too late in raising rates to combat inflation. And now I think they're going to be too late in trying to lower rates and perhaps save the economy. I don't know. The charts are telling me, I think we're at a stage where we got to be really careful. I think the Fed needs to start cutting rates right now. And so let me show you what I'm looking at on the charts. First off, I want to pull up this chart of the consumer price index. This obviously is one of the charts the Fed watches closely. And at the top of this chart, just to explain what's going on, this is the actual CPI, the core CPI reading every month. And then down below, I have a rate of change, which shows just month over month change. And then down below that in this lowest panel, I've got the 12-month rate of change, so the annual rate of core inflation. If you look, Fed Chief Powell's been talking now for the last couple of years about needing to see some improvement and seeing a move in our inflation rate at the core level, the CPI, moving down toward its 2% target level. Now, we were up at, we were getting monthly readings at 0.8 back in 2021. Which if you multiply that times 12 would be all the way up at 9.6% annual reading. We never saw that because if you add the 12 consecutive months together, the highest we ever saw was 6.7. But still, back in 2022, we had a peak there at 6.7%. And we have now seen over the past almost 2 years now, we have seen that drop from 6.7% down to 3.4%. And if you look at the individual monthly core CPI readings, we've seen it drop from the 0.8 and above level down to last month's reading of 0.16%, which you can see over here on the left side of this chart. So, if you go back and you study history and just go back throughout the first, let's say from 2005 to 2019, before the pandemic hit, you'll see that the monthly core readings all came in mostly between 0.3 at the high side and 0 to the downside. We had a couple of outliers just above 0.3%, couple of outliers just below 0. But for the most part, if you go back over those 15, 16 years, we were pretty much between 0 and 0.3. Now, we saw the monthly rate a little more than a year ago. I think that was maybe in the June 2023. I think that reading went down to 0.19%. And then, like I said, last month's reading, the May reading came in at 0.16%. So we've had a couple in the middle of that 0 to 0.3 range. But you can see now over the course of the last 12, 13 readings, we have had just about all of them at 0.3 or below. So I think we're getting closer and closer to this target that the Fed is wanting to hit. And yet, they're not really doing anything yet with interest rates to protect against perhaps a recession coming. But now we see these monthly readings now all shooting lower. We've been in a downtrend for 3 years now, and we're down into the 0.2 range, and we've had most of our readings in this range. So my question is, why are we waiting? Again, we've got those two mandates. One is to stabilize prices, and the second one is to maximize employment. Now, I'm going to show you a couple of other charts, but get a sense first of what's been going on with the inflation rate, and not just the monthly, but also the annual, which has been going down every single month for almost 2 years now. Take a look at the unemployment rate. Now, this goes back 50 years. So this is taking us all the way back into the mid-1970s. But you can see that when we have bouts of rising unemployment, this happened in 1979 all the way through 1982, end of 82. We had a pretty rough market through there. We also had a recession. 1989 through middle part of 1992, we saw rising unemployment. Again, we had the Persian Gulf War. We had a lot of issues with the market. We had a 20% cyclical bear market back then. If you look here to the next time we bottomed and had a strong move up in unemployment, we went from 2000 to 2003 with unemployment rising. That was pretty rough period in the market. That was when the secular bear market began in 2000. The S&P 500 got clobbered over those 3 months. And then at the beginning of 2007, all the way through into the latter part of 2009, inflation rising. What happened to the market? We had the financial crisis. Absolutely, market got crushed to the downside there. And then again, from 2019 at the low, of course, the pandemic, very difficult to guard against. And we had the huge move up in unemployment. And as a result, market took another big beating, really a crash over about 4-week period. But look at what's happening right now. I mean, the unemployment rate, which back at the beginning of 2023 was at the lowest we've seen in probably 7 decades, has turned up now. And over the course of the last year and a half, we've been seeing unemployment rise. Now, if you notice, unemployment in some of these instances, like here in 1989, rose. We didn't have a recession for another year and a half, maybe longer. In 1979, we started to rise, and it wasn't until sometime in 1980, 81 that we started to see that recession really take hold. So we're getting to the point now where I think the Fed needs to be cautious about their second mandate. All right. The first mandate, inflation, is coming under control. I mean, I don't know how to better illustrate it than show you that chart that I just showed you. I'll pull it up again. I mean, is inflation not coming down? Are we not screaming every single month down toward the 2% target? And by the way, when we were down in this range from 2012 to 2020, this is the annual rate of core inflation. We were anywhere from about 1.5 to up to about 2.4. It wasn't like we sat at 2. We were as high as 2.4. We're sitting at 3.4 right now, having come down in the last 2 years from 6.7. I think we're moving in the right direction. I think we got things under control. We're getting it there for sure. It is time to look at this chart. Here's where the unemployment rate's jumping. It's not just the unemployment rate. Look at the trend in initial jobless claims, because here we bottomed in initial jobless claims 2019, and then they skyrocketed. Of course, that was the pandemic, so I'll write that one off. How about 2006? That's where we bottomed in initial jobless claims. And in 2007, late 2007, the market topped, and 2008 was the Great Recession. Look back further, 2000, we bottomed. The recession, the big recession that hit back during the dot-com bubble. Here in 1988, early 1989, initial jobless claims bottomed. And as they started to turn higher, that took the market down. We had the recession in the early 90s. 1978, we bottomed on initial jobless claims, started moving up off of that. What happened? Early 1980s recession. 1973, we bottomed in initial jobless claims, started rising. What happened? Big move. I mean, anybody, my age or older certainly remembers the oil embargo in the mid 1970s. It was horrible in the stock market. It all started coming off of these low initial jobless claims. Look at where we just bottomed in 2022. Here we are now, a couple years later, starting to trend higher, especially here in 2024. Initial jobless claims have been moving up almost week after week after week. I don't think we're quite in, that problem area where things are starting to spiral out of control, but it's time for the Fed to start looking at what I'm looking at, which is a deteriorating economy. If they focus too long on inflation and they neglect what's going on in the economy, this next recession potentially could fall right on the shoulders of Fed Chief Powell. That's how I feel about it. I mean, right now, as I look at sentiment, this is the consumer sentiment reading, University of Michigan consumer sentiment reading. We're moving lower. Now, probably the biggest thing to take off of this chart, and it's really a good take, when we bottom in sentiment, we actually bottom in the stock market as well. 1980, when we bottomed in this consumer sentiment reading, that was the start of a 20-year secular bull market. 1990, we bottomed. What happened? That was the end of the Persian Gulf War. We started, we had a 20% cyclical bear market, but then we recovered off of that. 2009, you can see we were down at the low in consumer sentiment. What happened after 2009? We had one of the biggest recoveries ever. 2011, mid 2011, consumer sentiment again down at about that 55 area. Bounced off of that. We had another big run going into 2012, 13, 14. 2022, the bottom of the cyclical bear market. Where was consumer sentiment? The lowest reading we'd ever seen in the last 50 years. It was horrible. What happened? I mean, that's when everybody's throwing in the towel. That's the bottom, folks. When you get sentiment up here at the top, that's when you need to worry. These red arrows mark where we were at key tops over the past 30, 40 years. Here was 1990, right before we had the recession and the cyclical bear market. We were up at 95 on sentiment. In 2000, when we had the pandemic, we were not prepared for any bad news. Consumer sentiment was at the highest level we've seen since back in the 1970s. How about 2007? Sentiment at the start of that secular bear market decline, we were up over 95, 97 or so. And then in 2020, we were up over 100. Currently, we only got to 80. So it's not like folks are really, sentiment's not off the charts bullish to the upside at this point. People aren't feeling that great about things. And that might be one thing that helps us currently. But there's also no there's no doubting the fact that we are moving lower, and we've been moving lower in consumer sentiment throughout 2024 while jobless claims have been going up, while unemployment has been going up. And we know what history tells us about all that. So I think we could be heading into a kind of a perfect storm later in the summer. I've been talking to our members at Earnings Beats a little bit about that, when I think we could really see things start to kick in. But we're going down the wrong path right now, folks, from an economic perspective. And unless Fed Chief Powell decides, hey, it's time to start cutting rates to help the economy, longer he waits, I think the bigger problems we're going to have. Anyhow, if you like this video, make sure you like it, subscribe to our channel. I'll keep you posted, up to date on the things I'm seeing in the market. Absolutely would love to build up this YouTube community. So please, again, like the video, subscribe to our channel, and I'll see you for our next video. Have a great day, everybody. Happy trading.